Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York on Friday. Finally, happy Aloha Friday as we say on the islands, the 22nd day of November 2013, and this is the Daily Report, our weekend review. Very, very interesting week. We have seen this market under severe pressure. Today, kind of quiet actually in gold specifically, currently trading in essence unchanged to up $1. You're looking at 1242.70. That's the current print. And as I said, puts it roughly unchanged, 1240.50 on the low and 1250 on the high. So not very much of a range. Silver is under pressure this morning, trading off almost 0.75%, 0.14 or 14 cents lower. Current print 1982, the low 76, the high 2017. We'll talk about silver a little bit towards the end of the show. Traders, on today's report, I want to look at the lows that we hit this week and really focus in on how those numbers on a technical basis have some merit and what our exact strategy is going to be going into next week with our current short positions in both gold and silver. Of course, we did get short this market roughly at mid 1270s area. We started suggesting it on Monday and Tuesday and put out a firm trade alert on Wednesday. Anyone who wasn't short, get short now. The market at that point, I believe, was at 1276, currently trading around 1243, but that number is significant. It's significant for a couple of reasons, and I want to first look at the big picture. This is a 720-minute chart, but on this 720-minute chart, there are a couple of places we want to look at. And the first thing that we want to look at is the 76% retracement, which comes in at 1240. Let's go ahead and draw that line in here. You can see that it was a dotted line. It's really coming from this longer fib retracement. These retracements here, of course, are coming from this move up, 1435, down to, call it 1357, and then I have a third one in here, and those numbers are right here, and that's going from roughly 1365 down to this low at 1257. But really what we first want to focus on is the fact that the lows that it hit as this market sold off when we saw a dramatic sell-off this week did seem to find some support, at least on a tentative basis, at least for this week, right here at a pretty critical area. Now, to really put this most recent decline into perspective, I have gone ahead and pulled up a daily chart. This daily chart is the chart that we have been using recently for our sub count behind this intermediate count. Now, on this particular chart, I have our intermediate count in red. And this is our failure. We're still in a bullish cycle. We fell at the top X, and therefore we have intermediate 1, intermediate 2, intermediate 3. Now we're breaking down our subcount in our most current market activity, this being intermediate 4, and as I have said, I believe that we're currently in our intermediate 5. Now, why is that so important? Well, typically you are going to get a 5 or a 3 count at least on this last wave 5. So the way I see the count right now is it's very likely that we are in wave 3 of 5. Now, that being said, that we are currently in our wave 3 of 5, realize that just like Russian dolls or the fractal nature of Elliott wave itself means that we can then take this wave 3 and begin to subdivide that, and we should get a 5 count or a 3 count in this particular sub count underneath this 3. Because here's the thing, I personally don't believe that we have absolutely concluded 3. And one of my reasons for that is that if wave 3 cannot be the shortest of the impulse waves, and we already have a benchmark of wave 1, the conclusion, unless it's called what's called a truncated wave, the net result of this wave 3 should be a move that's about equal. Now, we've charted that, and we've determined that if that is how the market unfolds, we could see gold trade as low as 1181, which is that most recent low. That's where that extension would take us. However, you can get a market that just moves straight down, but you're also likely to see the market basically have the counter waves within these waves. And what I mean by that is we could see something like 1, 2, 3, 4, and 5. That's just one possible model. The reason that I bring that to your attention is if we see some real support, any kind of real support come into the market beginning of next week, we know that this particular point, this line in the sand, 1237 on the 76% retracement level, that's of this move here, we know that there's a possibility that we'll see some sort of a bounce. It doesn't mean we want to get long, but it might mean that we want to pull profits on our short position. But if we see that the market really is teetering and is not having an effective time really finding support right in this area, we'll look for it to break lower and to break down. But we are at a point that if we're going to see a pivot, if we're going to see some kind of a counter wave come in here, this is a logical place to look for it because it's at a significant Fibonacci retracement number. Now, to get the kind of sub count that we're looking at, we really need to look at a chart that has a much smaller time cycle. So I have converted our daily chart into a 360-minute chart. So all of our markings are still there, our fib retracements are still there, and we can see this is the top of 2. This is that third wave that we've been talking about. And once you take it down to this level, you begin to be able to see the possibilities of a wave count. 1, 2, 3. So we could easily be in 3 of 3. And if that's the case, we'll probably see this market head lower again, having this wave 1 as our benchmark. But what I think you can see is that to get that sub count, we really need to begin to look at much, much quicker time cycles. That being said, we have technical evidence that tells us that there could be a pivot point here, but when we look at the bigger picture, it tells us that we're probably still deeply ingrained within this corrective wave 3. Now, before I go ahead and pull up our weekly chart to conclude the gold charts for this weekend review, I've converted that 360 back to our daily and compressed it. And there's one other number that kind of fits in here, so it's worthwhile bringing it to your attention. And that is, I have a fib retracement from roughly 1050, 1042 up to our record top. When I do that and I look at the 76% retracement level, that comes out to 1249 or 1250. Now remember, I'm always looking for the Fibonacci harmonics, for the clustering using different time cycles, different sequences, and seeing where you get some sort of an alignment. And so you've got 1249 and 1237. Yes, they're off by about $12, but at the same time, they are in the same area. The other thing that to me is very, very significant about this particular number is that when we actually go ahead and do our retracement, you have this series of tops that come in right here, this 1250. And I remember this quite well as the market came up, because this is after it had just hit $1,000, came back down to 700, that's right, below that, and then came back to 1042. To see that, we'll pull up our weekly chart, but we'll continue to look at this 1249 even in that chart. So we've gone ahead and we've pulled up our weekly chart. This, of course, just has an intermediate count. We've been looking at our upper level resistance trend line with that. We have had in the past this longer retracement from about 700 to the record top. And this is that secondary fib retracement that we just spoke about that you saw on the daily chart, coming in from roughly 1050, 1043 right here. It is a significant area because all of the lows that you'll hit, in other words, after a peak and the market comes down, this is the low that you're going to set it at, or this low here, or this low here. These are the points that you look at. When we do that, of course, the big picture of the long retracement, and that is what I am looking at as a potential ending point for this corrective action if this plays out logically. But here's that 76% retracement at 1250 that we just talked about. Markets, of course, at 1243. And then also this is that significant top that we just looked at on the daily chart. So to put that in perspective, we have this being the ceiling, this being a floor. That's the type of technical, what I call historical precedents or information that we can use as market technicians, because we're always looking at past price moves to try to analyze or forecast what might happen in the future. So this could be a significant area, and it could just rip through this like a hot knife through butter, so to speak, because there's no doubt we have seen this dramatic decline. One real nice little rally, couple $100 rally, but besides that, we have had a market that has been characterized by corrective action that has been significant and really has taken its toll in terms of eroding the current price of gold per ounce. When we take a look at the current silver market, we'll find that the area that it has found support is, just as in the gold, a logical fib retracement area. Current price, of course, is 1986. And we've talked about the fact that roughly around there was this 76% retracement level, and that seems to be where the market has currently found some sort of support. This is 67, so we're trading roughly 20 cents off of that particular low. Again, as I've talked about all week, if we see the market break through, and if we see gold begin to break through the support levels that we have just talked about and identified, just as I think we could easily see gold go and retest the 1181, if that would happen, I think that we would probably see silver go and retest as low as $18 per ounce. This has been Gary Wagner, wishing you, as always, good trading. Maintain short positions in both gold and silver. We'll look to trail stops up at the beginning of the week. Have a great weekend. We'll talk to you on Monday. Bye-bye.